Good morning. Happy Wednesday. Finally getting some good weather here in Philly. Just wanted to talk a little bit today about something that I thought everyone should be aware of. If you've ever turned on the financial news or read Wall Street Journal or anything like that, you quickly kind of come to realize that there are countless ways to categorize stocks. There's different sectors, industries, indices, ETFs, all different ways to group stocks. And I wanted to talk about one very basic way, and that is to essentially bisect all stocks into two groups, those known as growth stocks versus those known as value stocks. And history has shown us that a balanced portfolio between these two groups is much better equipped to provide returns in any different type of market conditions. And that's really the goal, is to create a portfolio that provides you consistent returns regardless of the state of the market. So starting with growth stocks, these are stocks that a lot of people are familiar with. The strategy is a lot more straightforward. You kind of buy at a low price, hopefully, and sell at a much higher price. You're just looking for the share price of the stock to appreciate as much as possible. So some very famous growth stocks are the FANG group, Facebook, Amazon, Netflix, and Google. Sometimes they throw Apple in there as well. These just inherently, these are all, those are really the best of the growth stocks, I would say. But inherently, it's a little bit more speculative when you're investing in these companies. Because their moves and their the amount in which they appreciate is not necessarily strictly based on their fundamentals and their financial stability. They're much more prone to trends. And for instance, Apple's surge of late has largely been facilitated by them buying back their own stock, taking the money that they got from the recent tax cuts and buying their own shares. So that's kind of another inherent principle of growth companies. They tend to invest most of their earnings back towards the growth of the company itself. Now, on the value side, this is a lot more geared for long-term investing. Value, when you invest in value stocks, these stocks are a lot less volatile. They're not going to move up and down as much. The share prices are not going to move as much. And it also pays off to have a better understanding, a little bit deeper understanding of the fundamentals of the company, knowing that they're financially sound, knowing where they stand in their respective industry, having an idea of the strength of their management team. All of these things are important to at least have a little grasp on before you invest in value stocks. One of the ways in which value stocks really coincide with long-term investing, they lend themselves very well to long-term investing, is because value stocks tend to pay their shareholders dividends. So a dividend is a fixed amount that they pay each shareholder for holding each one of the shares. When you buy a share of a stock of a company, you're essentially giving a company your money as a loan. And a lot of people think value stocks are good because when you give them that loan, value stocks that pay dividends, they pay you on a quarterly basis. They say, if you're going to buy one share of our company, we're going to give you $1 every quarter just for being kind enough to invest in our company. So just because the share price may not move as much, you still have some earning potential from dividend income with value stocks. So leaving you with another question today as it pertains to dividends. There is something that a lot of investors refer to as a yield on a dividend producing stock, on a value stock. Who knows what the term yield corresponds to? What does yield mean when people talk about value stocks? Leave your answers in the comments. Hope that sheds a little bit of insight, gets some people thinking out there. Hope everyone has a great day. Take care.